On August 15, 1971, President Richard Nixon interrupted Sunday night television to deliver a message that would upend the global financial order. In a calm, measured voice, he announced that the United States would temporarily suspend the dollar's convertibility into gold. Overnight, the world's money changed. The gold anchor that had held currencies steady for a generation was gone. Markets froze. Currencies tumbled. The Nixon Shock had begun. The impact was immediate. In London, traders scrambled to recalculate exchange rates. In Paris, central bankers called emergency meetings. In Tokyo, the yen soared and then crashed. The Swiss franc spiked. The world's newspapers ran headlines about the end of money as we know it. For the first time since 1944, no one knew what a dollar or any other currency was really worth. A single TV address ended 27 years of global monetary stability. How did one weekend change the value of every currency on Earth? The answer is in the way trust, power, and gold had been fused together since World War II, and how, in a single moment, that fusion was broken. The emotional echo was instant. The panic of 1929, the chaos of the 1930s, the uncertainty of every modern currency crisis. Each time, leaders promised stability. Each time, the rules changed and the dominoes fell faster. The contrast was stark. While Nixon spoke of temporary measures, the world's financial system was being rewritten in real time. But to see why Nixon made this move, we need to go back to the gold-backed world he inherited. In July 1944, as World War II raged, delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. The world's financial system was being rebuilt from the ashes of depression and war. The deal was simple but revolutionary. The US dollar would be pegged to gold at $35 an ounce, and every other currency would be pegged to the dollar. The emotional impact was hope and relief. Europe and Japan, devastated by war, needed stability. The dollar became the world's reserve currency, the anchor for trade, aid, and reconstruction. The Marshall Plan poured billions into rebuilding shattered economies. American factories roared, shipping goods and capital across the Atlantic and Pacific. The system worked, at first. Fixed exchange rates brought predictability. Central banks could exchange dollars for gold at any time. The world trusted America's promise more than gold itself. The emotional echo was confidence. The dollar was as good as gold, and the world believed it. But cracks soon appeared. By the late 1950s, the U.S. was running persistent trade deficits. Dollars flowed out to pay for imports, military bases, and foreign aid. The eurodollar market was born in London, letting dollars circulate outside U.S. control. The world's addiction to dollars grew, but the gold backing was running thin. The economic term balance of payments became a daily worry in Washington. Foreign central banks, especially France under Charles de Gaulle, began to question whether the U.S. could honor its promise. Gold reserves at Fort Knox dwindled. The emotional tension was rising. The world's trust in the dollar was being tested. How did the dollar become the world's anchor? Why did the world trust America's promise more than gold itself? The answer is in the way the U.S. fused economic might, military power, and the promise of convertibility into a system that seemed unbreakable. But the gold anchor was already slipping, and the world was about to find out. By the early 1960s, the world's faith in the dollar was being tested in the vaults of Fort Knox. The United States, flush with post-war confidence, was spending on everything: the Vietnam War, the space race, the Great Society. Dollars flowed out to pay for troops in Saigon, rockets at Cape Canaveral, and aid to allies from Berlin to Tokyo. But every dollar sent abroad was a claim on America's gold. The balance of payments turned negative. The gold in Fort Knox, once the world's largest hoard, began to shrink. The emotional echo was anxiety, the pride of a superpower, the pain of watching its reserves melt away. Foreign central banks, led by France, started to call America's bluff. Charles de Gaulle sent warships to New York to collect gold in exchange for dollars. The world's newspapers ran photos of French officials loading bullion onto ships. The message was clear. Trust in the dollar was not enough. People wanted metal. The economic term Triffin dilemma became a daily reality. Economist Robert Triffin had warned that the very success of the dollar as a reserve currency would undermine its gold backing. The more the world used dollars, the more the U.S. had to run deficits. The more deficits, the less gold to back the promise. By 1971, the gold anchor was slipping fast. The U.S. faced a choice: defend the gold or defend the dollar. They couldn't do both. The emotional tension was at a breaking point. The world's trust was turning into a run on the bank. Why did America's gold vaults start to empty? What happens when the world's trust turns into a run on the bank? The answer is in the way promises, once stretched too far, can snap overnight. Nixon's team faced a choice: defend the gold or defend the dollar. They couldn't do both. On Friday, August 13, 1971, President Nixon summoned his top economic advisors to Camp David. The mood was tense, the dollar was under siege, gold reserves were vanishing. Foreign governments were lining up to exchange their dollars for gold. The world's financial system was on the brink. In a series of secret meetings, Nixon's team debated the options. Treasury Secretary John Connally, Federal Reserve Chairman Arthur Burns, and a handful of trusted aides weighed the risks. Defend the gold standard and risk a run on Fort Knox, or break the promise and risk global chaos? By Sunday, the decision was made. The United States would close the gold window. No more dollars for gold. The dollar would float. The world's money would be backed by nothing but trust. On Sunday night, Nixon went on national television. In a calm, measured voice, he told the world that the U.S. would temporarily suspend convertibility. The word temporary was a fiction. The gold standard was dead. The emotional shock was immediate. In London, traders scrambled to recalculate exchange rates. In Paris, central bankers called emergency meetings. In Tokyo, the yen soared and then crashed. The Swiss franc spiked. The world's newspapers ran headlines about the end of money as we know it. The economic term fiat currency became a reality. The dollar was now backed by nothing but the full faith and credit of the U.S. government. The world's currencies began to float. The era of fixed exchange rates was over. How did a secret meeting rewrite the rules of global money? Why did Nixon act before the markets could react? The answer is, in the way power, secrecy, and speed can change the fate of nations. The world woke up to a new reality, one where money was backed by nothing but trust. On Monday morning, August 16, 1971, the world's financial markets opened to chaos. The dollar, once as good as gold, was now just another piece of paper. Currencies began to float. The pound, the yen, the franc, all scrambled for footing. The dollar devalued. The emotional echo was confusion and fear. The old rules were gone, and no one knew what would come next. Inflation surged. In the United States, prices for food, gas, and housing soared. The term stagflation, rising prices and stagnant growth, became the new nightmare. The oil shocks of 1973 and 1979 sent gasoline prices through the roof. Lines stretched for blocks at gas stations. The world's leaders scrambled for answers. The economic term floating exchange rate became a daily reality. Central banks intervened, but the markets set the price. The dollar's value swung wildly. Gold soared from $35 to over $800 an ounce. The emotional toll was deep. The promise of stability was replaced by the reality of volatility. The petrodollar system was born. In a series of secret deals, the U.S. convinced Saudi Arabia and other OPEC nations to price oil exclusively in dollars. In return, the U.S. guaranteed their security. Every country now needed dollars to buy energy. Oil profits were recycled into U.S. treasuries, funding America's deficits and cementing the dollar's dominance. How did the end of gold unleash a decade of chaos? Why did the world's money become a moving target? The answer is in the way trust, once broken, is hard to rebuild, and how every new system creates new winners and losers. But the end of the gold standard was also the birth of a new financial order. Before 1971, money was a promise, anchored to gold, trusted across borders, and limited by the weight of metal in a vault. The gold standard was more than a policy, it was a psychological anchor. Every dollar, pound, or franc was a claim on something real. The emotional echo was certainty. Savers, traders, and nations believed the rules couldn't change overnight. After Nixon's shock, the world entered the age of fiat money. Currencies were now backed by nothing but government decree, monetary sovereignty in its purest form. Central banks could print at will. Politicians could spend without the discipline of gold. The emotional shift was profound. Certainty gave way to volatility, and trust became the new currency. The 1970s and 1980s were a laboratory for this new order. Inflation soared, then crashed. Exchange rates swung wildly. The dollar, once just a measure of gold, became a weapon in global currency wars. Nations devalued to gain advantage. The world's money map was redrawn again and again. The contrast was stark. Under gold, money was slow, heavy, and hard to manipulate. Under fiat, money was fast, light, and infinitely flexible, but also fragile. The emotional parallel is clear. The panic of 1929, the chaos of 1971, the uncertainty of every modern crisis. Each time, the world's leaders promised stability. Each time, the rules changed and the dominoes fell faster. Did money become more free or more fragile? What did the gold standard teach us about the dangers of trust? The answer is in the way every system, no matter how strong, is only as good as the faith that sustains it. So what can you do as the next currency reset looms? Nixon A.S. 1971 decision to close the gold window was more than a policy shift. It was a turning point in the story of money. The world's currencies, once anchored to metal, now floated on trust alone. The emotional echo is timeless. The pride of a nation at its peak, the pain of inflation, the shock of waking up to new rules. The panic of 1929, the oil shocks of the 1970s, the uncertainty of every modern crisis. Each time, leaders promised stability. Each time, the rules changed and the dominoes fell faster. The cycle repeats. Every generation believes its system is permanent. Every government thinks it can print, borrow, and spend without consequence. But history shows that the greatest financial empires are built on trust, and that trust can vanish in a single weekend. Will you be ready when the next gold window closes? Will you recognize the signals before the headlines hit? The answers are hidden in the past, if you know where to look. Don't assume the rules of money are set in stone. Watch for the signals: rising debt, sudden deals, the quiet transfer of strategic assets. Pay attention to the canaries, gold flows, new alliances, and the fine print in every contract. In every reset, someone is early, someone is late, and someone never even realizes a reset happened. Will you be ready when the next reset comes? Will you recognize the signals before the headlines hit? Subscribe for more cinematic economic history and learn how to spot the next reset before it hits.